I spent 3 years trading pure price action, and it almost made me quit trading altogether. Today, I will finally explain why I gave it up, the mistakes it caused, and how switching to my market mechanics system completely changed my trading results. Now, first of all, quick little disclaimer, I'm not saying that price action does not work, okay? I know so many traders out there insanely profitable trading just candlestick patterns. And there are even traders who trade wedges and weird triangle patterns just like this, and they make more money than me, alright? So I'm not here to complain or shame any sort of trading strategy. I'm just saying that I've developed my own trading system that works better than price action. This is based on my own personal experience over the past 6 years. So know that this is not a sermon. I'm not forcing you to do this. I'm just telling you what I've done to actually become profitable, right? So this is the documentary, not a sermon. So first of all, let me talk about how I actually discovered price action trading. So as a naive young man, right, this is me. I started trading because my friend actually introduced me to it. He was like, hey Brad, there's this way to actually make money online. You know, you can just make $500 easily just by clicking the buy and sell button. And back then, I was earning less than $1,000, working as a waiter, as a temperature screener during the COVID-19 era, right? Pretty much just working all these different odd jobs, making like $7 to $10 an hour, right? So as a result, obviously, I was enticed by this offer, right? Making $500 just clicking a bunch of buttons while I'm over here slaving my ass off under the hot sun, serving drinks to customers who hate me, who are unreasonable, who are shouting at me for serving them the wrong drink, right? Which is my fault, by the way. But anyways, I was like, okay, cool. This is a very good opportunity. So I started diving into forex trading. I started learning about the financial markets. And the first strategy that I found was obviously price action, right? Because this is the most common trading strategy in the retail industry. When you search up how to trade online, you will see this, right? You will see resistance and support levels. You will see trend lines, chart patterns, and candlestick patterns. And the trading industry has convinced you that if you magically memorize all of these candlestick patterns on this cheat sheet, you will become profitable. If you draw a bunch of lines on your charts, you will know exactly where price is going to reverse. Well, that just couldn't be further from the truth, right? But it wasn't until after 3 years later, then I found out that, yeah, this is bullshit, right? But anyways, what happened next is that I started learning about the trend lines, the support and resistance levels. And the thing is, because of the fact that it's so simple, I was like, there must be more towards trading. Like, there is no way professional traders are managing billions of dollars. They're just sitting there drawing a bunch of lines on their charts and just trying to spot patterns just like this, right? But yeah, the main thing that attracted me was because of the fact that it was so simple, right? It was so simple to use, and it was also somewhat accurate since I did not have to rely on weird indicators and have like different sort of lines and like weird, I don't know, patterns on my chart, right? So as a result, I was attracted to price action. And till this day, let me just show you, I actually still have my trading journal back in 2021, 2022. You can see, this was my price action era where I was trading price action. You can see all my trades right here, got stopped out right here, learned my lesson, got stopped out right here again, learned my lesson, right? And you can see, this was how I managed to get proficient at trading price action, just by using it and just by gathering data to find out what works and what didn't work. And you can see a lot of times, like 8 out of 10 times, it wasn't working. Like for some reason, price always hit my stop loss and then the trade go in my way. And then as I get better at trading, because I was starting to get more proficient at price action, I actually started seeing some results. I actually made my first $100 trading a chart pattern. I believe it was the double top at the point of time, entered for sell right here, and then price went down, and I actually made a good amount of money, right? $100 was quite big to me back then, to a guy who was earning $7 an hour. And then I managed to make some small wins here and there. You know, I was making $300, I was making $500, and then there was even this one time where I managed to turn $500, which was all I had in my trading account, to over $10,000 in the span of a few days, right? In a span of 5 days. And this was when I thought that, holy shit, I really discovered the Holy Grail. And I can't believe the Holy Grail is so simple. All I got to do is to show up to the charts, identify a bunch of lines and a bunch of patterns, and then I will be able to quit my job, and then I will be able to retire my parents. Yay! Then next thing you know, I got complacent, right? Boom, lost this $10,000 in one trade. You heard that right. One big loss wiped the entire account out. right? And I got margin called. And then because of the fact that I've seen some results, I started to deposit another $500 into my account, thinking that, you know what, if I can do this, right? If I can turn it into $10,000 in 5 days, I can do it again. But then I managed to turn it to like $3,000 and then I lost it all, right? And then I just kept going into this vicious cycle of depositing money into my account and then losing everything, right? So I was stuck in this vicious cycle of unprofitability for the longest time. Like I would just make some money here and there, but a lot of times I always end the month off with a negative P&L, like negative $1,000, negative $2,000, and slowly those losses add up. Next thing you know, I've actually lost all my life savings. Like I had literally no money in the bank account. I was at rock bottom, and that is when I decided that, you know what, maybe there is another way to do this, right? Because when I actually turned the $500 to $10,000, it proved to me that it is possible to make money from trading. It is possible for me to actually achieve freedom from this craft. Or perhaps because I have the wrong mindset when it comes to trading, right? The wrong mental models. And that is where I came across this quote by Mark Douglas, which says that consistent winners think differently from everyone else. Right? So when he actually said this, it pretty much gave me like a aha moment, right? I thought to myself that if everyone else is trading chart patterns, trend lines, support and resistance levels, and a statistic says that 95% of traders are losing, which is the majority of the traders, then maybe I shouldn't be going this way. Maybe I should be going the other way. Maybe I should take advantage of these retail trading strategies and create a strategy that allow me to profit from these people's downfall. As evil and Machiavellian that actually sounds, but that's true, right? I was like, instead of doing what the majority of traders are doing, why don't I start doing what these people are not doing? What is psychologically uncomfortable and what is outside of my comfort zone so that I can actually achieve the results of this, right? Consistent winners. So I can actually make consistent profits. Now, before I show you how I develop my own unique edge, which is market mechanics, let me talk about the problems for price action. So I've created this acronym called SIN, S-I-N. So it is a sin to trade price action. Nah, just kidding. But it is a sin to actually trade with your emotions, to actually not be profitable. All right, that is a sin, all right? Because it is very much possible to become profitable. And if you're not profitable because you're trading price action, that is a sin. Okay, so S pretty much stand for subjectivity. So what do I mean by subjectivity? Well, what it means is that two price action traders, they can interpret the same chart differently. That is why I say that price action is often discretionary and subjective. Or rather, price action trading is, right? Price action itself is not subjective, but price action trading is subjective. What that means is that, for example, today, let's say price is going down and then it creates like this pattern right here. All right. So when you look at this, as a price action trader who is trying to identify the chart patterns, I will see this and I think, okay, I saw like a double bottom right here. So I'm going to enter for a buy right here because that's what the chart pattern says, right? If you enter for a buy, when you see a double bottom, price is going to go up, right? Price is going to break through the neckline and you're going to be in profit. Yay. But then what you fail to realize is that another trader who is bearish is going to look at this and think that, okay, you know what? This is actually a double top. So I'm going to enter for a sell over here instead when price actually break through the neckline. And also maybe because price has been going down, this pretty much support my bias that price should be bearish. Once again, you can see this is the exact same chart, the exact same graph. But because of the fact that these two traders have different interpretations, they end up taking different actions. One enter for a buy, one enter for a sell. And both of these guys are going to get two different results because the market can only move in one way, right? It can either go down right now from here or go up. And then if the market goes down, then the guy who actually entered for a sell is in profit, right? Yay, this guy made $300. But then the guy who actually look at the same thing, look at the same double bottom, or rather look at the same graph and interpreted it as a double bottom, who entered for a buy right here, he's going to be losing like what, $3,000, $300, whatever. So essentially, he's giving his profits to another price action trader. Both of them using the exact same strategies, but because of how they perceive the market, one actually benefited and the other didn't actually benefit, right? So you can see this happens every single day. That's the nature of price action. It's so discretionary. Now, I pretty much stands for inconsistency. And this is caused by subjectivity, and is caused by a lack of mechanical rules. A lot of traders that are searching for consistent profits. But my question is, how do you actually expect to get consistent profits when your actions are inconsistent, when your strategy is inconsistent, when you are doing a different thing, a different set of actions whenever you approach a chart, whenever you start trading, when you have all of these different variables that is influencing your decisions on a daily basis, rather than having like a set of mechanical rules which tells you exactly what to do and following it to a T, right? So that's the problem. Because of this discretionary sort of approach, and because of this free will sort of approach, right, where you are just taking a set of actions, where you are just constantly imposing your bias onto the markets, it's very difficult for you to actually get consistent profits. Because some days you'll be trading trend lines, and then some days you'll be trading chart patterns, and then some other days you are trading some random candlestick patterns which you memorize from the cheat sheet right here. Once again, when you are doing all of these different set of actions every single day, it's impossible for you to actually get consistent results, right? So inconsistent actions leads to inconsistent results. So if you want to control the outcome, you must first learn how to control the variables, right? Control the conditions. Since we know that trading is a probabilities game, right? It's a numbers game. This means that we need to do everything we can to actually increase our odds of succeeding. And that comes with having like an edge. And the thing is, will not be able to increase your odds of success if you are constantly using different variables, right? You're constantly looking at the chart differently. Now, the final N stands for noise. So there is too much random price movement every single day that is influencing your decisions. Like I said earlier, price action alone often lacks a measurable statistical edge. What that means is that you can't backtest it properly because it's so discretionary. If you want to actually backtest your trading strategy and find out whether it works or not, it requires you to have a consistent set of variables that you are looking out for every single time you go onto the chart. It also requires you to have a consistent set of actions and processes that you are repeating every single day on the chart, right? So that you can actually look for your ideal trade setup. But the thing is, if everything is random, right? Every single time you trade is random, right? Every single chart pattern you find is different than the previous one. Every single candlestick pattern you use is different. How are you going to backtest? How are you actually going to test out your trading strategy to find out whether your strategy actually works or not? All right, so that is the entire acronym, SIN. I hope this actually gets embedded into your subconscious. All right, once again, I'm not saying that it doesn't work, right? Price action doesn't work. Like all of these shortcomings, all of these cons, there is actually certain solutions to actually fix them if you are trading price action strategy. But I'm just saying that in general, as a whole, yeah, price action have these weaknesses right here, which is a sin. Now, let me give you an example on the charts. So back in the 1990s, a group of traders actually bought oil at $40 a barrel during a major geopolitical event. Right, because you can see price spike all the way up here, right? Bullish engulfing candlestick. So they think that price is going to continue going up. So as a result, they enter for a buy right here. But then what happened next is that price actually started going down, right? Price started going down and price consolidated for years. And then about 13 years later, in 2003, what happened was that price of oil actually went back up to $40 a barrel. So at this point of time, the group of traders who actually entered for a sell right here, they decide to close their position, right? Because, they want to relieve themselves from the pain of actually losing all the money for the past few years, right? So as a result, they close their short position right here. And then another group of traders who saw this as a resistance level, right? Because price actually went down and reversed back in, it was 1990s, back when it actually hit $40 a barrel for the first time round. So as a result, that other group of traders that are going to be entering for a sell right here as well. So this actually creates selling pressure. This resistance level method, not because it was just a line like this, but because price has memory. Because this was the level where the range of traders experience the emotions of pain, regret, and profit taking. Like I said earlier, people who regret not entering for a sell right here, they enter for a sell now. People who regret entering for a sell right here, they close their short position here, right? So all of these actions create selling pressure in the market. And then a year later, that same resistance level actually became a support level, right? You can see price actually bounce off it and then goes up. Now, the reason why this actually happened is not because of the fact that it is just a line on the chart. It was actually because, number one, there was a fundamental paradigm shift. A paradigm shift is basically an intermediate to long-term shift in the perceived value of prices, right? So in this particular case, there was actually demand for hydrocarbons in China, right? So what happened was that since there was demand, price actually goes up, right? So at this point of time, there was that paradigm shift, which indicated that the fundamentals have changed. And right now, there's going to be lesser sellers and there's going to be more buyers in the market. And then later on, when price actually returned back to that $40 per barrel level, what happened is that once again, the traders who are experiencing the huge range of emotions from pain, profit-taking, and regret, they're going to be taking a different set of actions, right? So for traders who regret not entering for a buy right here, guess what? They're going to start entering for a buy over here since price is back to this $40 a barrel. And it's cheap compared to where price is currently at for the past few months. And then the traders who actually entered for a sell right here, who went into this huge drawdown when price actually rise tremendously, and now prices came back down to this exact level here, they're gonna get out of their losing positions, right? So they are gonna close their sell positions right here. So you can see, this is a level of, once again, pain, regret, and profit taking. And once again, this line becomes a support level because of the set of actions that were taken by a set of traders, a group of traders. That is why we have this support level that we have down here. Now, if we were to apply the concept of SIN over here, right, the acronym which I just shared with you, subjectivity means that most price action traders, they saw this $40 per barrel level as just like a horizontal resistance level. But here's the problem. If you ask 10 different traders, 10 different price action traders, I'm pretty sure you're gonna get 10 different answers on where exactly are they placing this resistance level. Some people are gonna be placing it exactly at $40. Some are gonna be placing it at 40.5, 450 even, right? They're gonna get a different set of answers, right? Because once again, this is subjective. And because they are drawing it differently, some traders are gonna enter for a sell right here. Some traders are going to enter for a sell right here. Some traders are going to miss out on the move to the downside when price actually reversed at this $40 barrel level because of the fact that they were waiting for price to get up to their resistance level, which they have drawn at the $50 point. Once again, exact same chart, different perception of the market, different ways of actually marking up the support and resistance level. They came with different conclusions. And the next is inconsistency. Because there are no strict rules whatsoever, the results are inconsistent. One trader, they might have entered for a sell right here, and then they might have made a profit. And then another trader might have waited for price to actually go all the way up there, and then they miss out on this trade right here. And then another trader who might have entered a little bit early at this support level, and they take a loss. Right, you can see different traders, different actions, different results. This is why I say without a mechanical process, you will not be able to get the same outcome every time. Like the market is already difficult enough. Trading is already hard enough. Don't make your life more difficult by leaving it to chance. Next is N, right? Noise. Now, price action traders, they often get caught reacting to every single wiggle in price action, right? At $40 over here, there was like a bigger story, right? We mentioned that this level had historical significance. That is exactly why price actually reacted from this level. It wasn't because of the line, it was because of emotions. It was because of sentiment. It was because price has memory. And by focusing on the core mechanics, which is the concept that price has memory, we are able to identify the objective truth and filter out all of this noise. Now let's look at a more modern example on TradingView. Like the example earlier, I wanted to show you on TradingView, but because it was so old back in the 1990s that TradingView just doesn't have the data that goes back that far, right? But anyways, let's look at this modern example. So this is on EU, right? And this is how a typical price action trader would trade. They see there's a resistance level here because of the fact that price goes up, reverse, goes up, reverse, goes up, reverse, right? So this is obviously a resistance level where price failed to break multiple times in a row. As a result, the next time price actually come out to this level, I'm going to enter for a sell right here, and I'm going to be placing my stop loss above the resistance level itself. So I enter for a sell right here, the minute price actually touch my resistance level, and then I place my stop loss above this high. Next thing you know, this candlestick wick actually wicked me out, triggered my stop loss, and now I open my eyes wide just to see price go in my way. And I sit there regretting, oh my god, I should have placed my stop loss, gave it a little bit more breathing room. Oh my god, I should have waited for price to take out this high, then I enter for sell. Bro, that is just being stupid, alright? Now, this is, once again, no shit, alright? If you're a price action trader, no shit, but this is how most typical unprofitable price action traders approach it. Now, let's look at a market mechanics trader, right? Let's look at a market mechanics example. Using this exact same chart, right? Once again, exact same chart, but a different set of actions, right? A different perception. So instead of entering for a sell at this resistance level, I don't even mark up that resistance level. I mark up supply zones, right? So we have identified that this is a supply zone because it led to a large amount of imbalance, a large amount of selling pressure. So we know that this is a price point which institutions tend to respect. But with that said, there is still a chance that price will break past this supply zone because there is always liquidity, right? There is available liquidity sitting above this highs right here. So when price actually started pulling back, right, pull back to this supply zone, I anticipated price to start reversing somewhere around here. I don't know when price is going to reverse exactly, right? Price can reverse over here, or over here. I don't know. But what I want to do is to look for my entry model and actually enter once it presents itself, right? Which means I'm not trying to enter immediately right after price react to like a random line on the market. No, I'm going to wait for price to show me my entry model, wait for further confirmation, wait for price to sweep some liquidity, then I enter for a sell. So what happened is that when price is pulling back up, right, it created this high right here. And then I didn't really mark it up, but you can see like there's like the fractal market shift right here, which means that this is a strong low, which means once again there's available liquidity sitting behind this strong low. So I waited for price to sweep that strong low, and then I made my entry from there. And then I placed my take profit here, and price later on went down to my take profit. But let's say I missed out on this initial position. The second place to actually enter would be the point of liquidation, right? The point of interest that swept liquidity. Since this is a supply zone that swept liquidity that caused price to took out this high right here, we know that this is the first time that smart money has actually entered into the market, right? So the next time price actually return to this price point, to return to this zone, I can expect to scale in, or I can actually enter again, right? So what happens is that price pull back to this zone right here, and then just nice, price also swept some liquidity that we have above this swing high right here, and then hit to the downside, right? So this is where I'll place my second position. Once again, you can see it. Let me just zoom out and show you guys. Exact same chart here, guys. No different, exact same chart, but a different way of approaching the market. One resulted in a huge profit, one resulted in a loss. And most importantly, this was executed without guesswork, without hesitation, without emotions. While this was executed based on a little bit of discretion, right? Hoping that price will actually respect this resistance level. Thinking that this is the correct resistance level. Now, going back to my trading journey, let me just talk about how I actually discovered market mechanics, right? So it was in around 2023 where I actually first enlisted into the military. Yes, this is me, right? This is actually when I first graduated from like the basic military training after being stuck on some island for like the first 2 months so that I could train how to actually become a soldier, how to shoot a rifle, how to actually dig a shell script and everything. Right, so at this point of time, this was when I was so sick and tired of actually losing money. Because remember, in the first 2 to 3 years, I was just in this inconsistent cycle, right? The vicious cycle of making money, losing more money, making money, losing even more money, and losing all my savings. So at this point of time, I was tired of losing. I was tired of being a loser. I was like, you know what? I need to start to figure out how to actually become profitable. I need to start to model professional traders. So I went into this rabbit hole of learning all the different trading strategies out there, right? To find out what is indeed the holy grail, the best trading strategy. So I tried SMC concepts, right? Which means I tried order blocks, imbalance, everything. And then I also tried ICT concepts, which means I tried fair value gap, turtle soup strategy, the silver bullet strategy. I tried every single concept, every single strategy you can think of. And bear in mind that this was on top of my experience with trading price action strategies as well. Right, so you can see this is where I pretty much developed like a lattice work of different strategies to rely on, right? And I realized that all of these concepts, right, all of these strategies are actually quite profitable. But the thing is, within each of these category, there is specific concepts which work better than other concepts, right? For example, when it comes to price action, the concept of momentum and volume and pressure works very well compared to the concept of support and resistance level, which doesn't work as well. And then, for example, when you look at ICT, right, the concept of imbalance, right, works very, very well. And then when you look at ICT, the concept of order blocks work really, really well compared to some random new strategy that he decide to name called like turtle soup or some shit like this, right? Right, so you can see this is where, based on data, I find out what is the most profitable aspects of all of these different strategies, and then I combine them together to form what I call market mechanics, which is all about uncovering the objective truth of the financial markets, all about perceiving the market for what it is, all about understanding what actually moved the market fundamentally, why price move, and how price move. And when I actually came up with market mechanics, it just felt like I finally found treasure, right? And this is where I developed my own edge, right? Because based on all of this data that I've gathered after trying out all of these different trading strategies, I found out what works and what doesn't work. And then market mechanics is pretty much a compilation of everything that works, and I got rid of everything that did not work. All of the useless fluff, all of the concepts which just did not make sense and were not profitable, I got rid of them, I threw them in the trash. And I only focus and double down on what actually worked. So what exactly is market mechanics? To me, market mechanics comprise of a few core components. Number one is mechanical market structure, which means when it comes to how I actually identify structure, right? The swing structure, the internal structure, the fractal structure, there is a specific set of rules that I look out for, right? That allows me to map my structure in the same manner every single time. And then there is also your institutional zones, right? Institutional zones pretty much stand for the point of interest which smart money are involved in, right? It pretty much allows me to spot the smart money footprints. So institutional zones are order blocks, flip zones, sweep zones, and institutional supply and demand zones. And then there is also your liquidity concepts, right, which comprise of inducements, low resistance liquidity, high resistance liquidity, and also push and pull inducements. And then most importantly, there is also your order flow as well, right? So these are the four key concepts that make up market mechanics. Obviously, there are a lot of tiny little nuances like time, right, which is a big factor as well. Like, what is the perfect time to trade, right? It's usually doing one of the Q zones, or London Q zone, New York Q zone. And another thing that I really look out for is the strength of the point of interest, and also things like currency correlation and even fundamentals, right, which is pretty much how economic factors actually affect prices. You can see, based on this, I pretty much developed like a lattice work of mental models to rely on, because I'm no longer just looking at price in the frame of technicals, but I'm also looking at price in the frame of fundamentals and aspect of capital management and also trading psychology. And I pretty much start to combine all of these concepts together to form my unique edge, which is called market mechanics. Until today, I have so much conviction in this strategy, because this strategy not only made me profitable, but made thousands of students inside the 1% Club profitable. And the thing is, it's not complicated once you actually understand how to piece all of these different puzzles together. It's just a set of rules, right? It's just a set of clear mechanical rules, a systematic framework that we look out for every single day on the charts. And if we are able to check all of the boxes, right, which means we have found a trade setup which checks all the criteria, all our entry criteria, all our exit criteria, we enter the trade without hesitation, reservation, or fear, right? We don't care about emotions. We don't care about second guessing or guesswork, because we have identified our entry models, we have done our research, we have done our preparation. All it takes is for us to trust our analysis. And if there's one thing that makes market mechanics so potent, so powerful, that would be this one thing called data. Because we are able to gather sufficient data about our edge, right? By actually doing the rule of 100, which pretty much states that you should be testing 100 trades so that you can find out what works and what doesn't work, so you can continuously refine and improve your trade plan. Because we have that data, right, to accurately execute our trade plan to the best of our abilities. And this data is the same thing that allowed me to actually finally break out of the vicious cycle of unprofitability and started seeing some form of consistent profits, and also allowed me to scale to 6 and even 7 figures, all because of this one thing called data. Now, bear in mind that this market mechanics strategy, it works on all asset classes, because once again, we have tested this across all the different instruments, be it futures, crypto, stocks, or whatever tiny little niche you like to gamble in. It works across every single asset class. The only difference is the fundamentals and the sentiments that move each one of these different assets, right? So obviously you have to make some minor tweaks to actually tailor this market mechanics strategy to the instrument that you are trading within. But overall, the concepts that we teach, the strategies that we actually pass down to our students, it works across all the different asset classes. Let me just show you my trading journal to prove to you that this shit actually works, right? So you can see this is my trading journal, and you can see these are my results. Last month, took about 4 trades, made about 180k, nothing too crazy. And then for the past few months, you can see this is my average win rate, right? You can see the amount of trades that I win compared to the amount of trades that I lose. And you will be able to see that my profits always outweigh my losses, right? This is how I managed to really keep my profits small and keep my profits big so that I can actually become consistent, right? So you can see this is like, it goes on, right? Since the start of this year, I've made a conscious decision to actually journal and record every single trade publicly on my second channel, Bread Trades, so you can see how I actually implement market mechanics in real time, right? In live market conditions, right? So I'm proud to say that I actually have the data to actually back it up, and I'm not just pulling this out of my ass. And the best part is I'm not glued to the charts all day long, right? Back when I was trading price action, I would stare at the charts from Asian session till New York session, from the time I wake up till the time I go to sleep. But nowadays, it's just chill. Like, just look at how many trades that I take per month, right? Probably less than 20. Well, back then, I would take more than 20 trades in 1 week. All right, that's how crazy it is, right? Right now, I'm more focused on quality over quantity, and this also means more time freedom because I was no longer good at the charts all day. And when I do spot a high quality setup, I actually try to capitalize on it by deploying more capital towards it. So that is really how I became profitable, and I made 6 and 7 figures. So yeah, that's pretty much why I decided to switch from price action to market mechanics. Once again, huge disclaimer, as much as I would like to sell you the dream of a holy grail, telling you that market mechanics is the 100% win rate trading strategy that will change your life, retire your parents, buy you that dream mansion, buy you that dream watch, well, that's not the case, right? The more of the story is you want to make sure that you develop your own edge, your own unique edge that gives you the competitive advantage over the rest of the traders, your own unique edge that suits your personality, your lifestyle, and your risk tolerance. Ultimately, it's all about finding what works for you. I'm telling you what works for me. I'm telling you that price action works, but market mechanics is more profitable. So please, for the love of God, do not compare your chapter 1 with someone else's chapter 10. Do not just blindly follow someone else's trade plan as well. Go and find out what are the stuff that works and what are the stuff that don't work based on your own iterative process, based on having like a tight feedback loop, and then using that data, develop your own strategy, right? That is my best advice I could give to any traders, be it beginner, intermediate, or advanced traders, all of my professional gamblers out there. And one thing that I will never ever change is my love of tea, all right? So you can see I'm still drinking green tea right now, bro. Look at this shit, bro. Right? Price action is gone. Market mechanics is here to stay. Green tea, still here to stay. So if you want to learn more about market mechanics, check out this free 10-hour course that I've created right here. I've already made enough money from trading, so I don't need to sell you signal group or any bullshit courses just like this. Just get the free value right here. Watch the full 10-hour course, learn about market mechanics, and if you want, right, you can always apply for my mentorship after watching this course right here. And as always, remember, you're just one trade away.